Hello, everyone. Welcome back to the interview series on the socioeconomic consequences of disruptive technologies by Rethinking Economics NL. Today, we will be focusing on on how technology is changing society and finance, focusing especially on finance in the 21st century from both a theoretical and practical perspective. For that, we have gathered three world-class experts for you. Firstly, we have Douglas Arne. He's a Carey Holdings professor in law at the University of Hong Kong and an expert on financial regulation, particularly in the intersection between law, finance, and technology. He is the faculty director of Hong Kong University's Master in Law in Compliance and Regulation and the Master in Law in Corporate and Financial Law, a member of Hong Kong Financial Services Development Council, and a senior visiting fellow of Melbourne Law School at the University of Melbourne. His Introduction to FinTech course, available on EDX, has over 75,000 enrollments, including by me, and is one of the best introductions of FinTech that I know of. Secondly, we have Navroop Sadev. She is the founder of the CEO of the Digital Economist, a global impact organization with a mission to drive technological convergence for a human-centered digital economy. It does so by bringing investable opportunities in line with the Sustainable Development Goals to the fore. She is furthermore an MIT Connection Science Fellow and holds a host of leadership roles in distributed ledger technology space. She is also a research associate at the Center for Blockchain Technologies at University College London and holds 3 masters in intellectual property management, economics of innovation, and applied economics. Navroop has co-authored Hyperledger's Blockchain for Business online course, which has trained over 160,000 entrepreneurs globally and counting. Lastly, we have with us today Daniel Azzi. He is an op-ed writer and lecturer in economics, monetary policy, and political reform, whose articles have appeared in Bloomberg, An-Nahar, and El Akhbar, the latter two being two of Lebanon's major papers. In 2019, he was also a Harvard Leadership Fellow, Advanced Leadership Fellow, where the focus of his research was, in his own words, on designing a political and economic reform program for a hypothetical small country riddled with corruption and negligence. Daniel Azzi has also served as the chairman and CEO of Standard Chartered Bank Lebanon and held various executive positions for investment banks, such as Bear Stearns in Hong Kong, Deutsche Bank in New York, and Merrill Lynch in London. The first question for today is for Professor Arne. Could you define what fintech is, how it has developed over the last decades, and how it is transforming the world of finance?
Thanks, Kurt, and thanks for the invitation to be here today. I think when we look at finance and technology have always been co-developmental since the very earliest history of settled civilization. We can think about some of the earliest advents of writing, of ledgers to keep track of monies owed for taxation. We can think of coins, metallurgy, and we can think of the evolution of technology over time and its impact on finance. But when we're thinking about fintech, we're really thinking about more modern period. We're thinking about a long-term process of digitization of finance and more recently of datafication of finance. And we really mark this across 3 different major periods. The first, from the late 19th century, the advent of the telegraph, which brings for the first time instantaneous communications across major markets. That underlies our first major period of financial and economic globalization. We see a second period really starting from 1967. Why? Because in 1967, we see the advent of 2 transformational technologies: the ATM machine, the automated teller, which fundamentally changed the way that people interacted with money, and the handheld calculator, which fundamentally changed the way that people and the entire financial sector engage with numbers and calculation. And between those two, in many ways, electronic payments, the ATM, and the calculator set the basis for what we've seen over the past 5 decades. Now, we can see this process of digitization across the 70s, the advent of NASDAQ, of SWIFT in the early 1970s. 1987, market crash. What's our best explanation? Program trading. What's program trading? Pre-programmed buy and sell orders. And we actually mark the beginning of a third period of financial technological evolution, of fintech evolution, in 2007, 2008. Why? Well, M-Pesa launches in Kenya in 2007. The iPhone launches in 2007. And of course, the global financial crisis starts in 2007, 2008. And one can really say that that combination of the mobile phone, of the financial crisis and post-crisis regulatory changes, along with electronic payments over the past decade and a half, fundamentally transformed our financial sector. In fact, we actually mark 2020 as the advent of a fourth period, a period based upon technological changes that we wouldn't have seen before. Think about Libra's launch in 2019, the impact of COVID-19 in the context of digitization of the economy, of society, and certainly of the financial system. And what we really characterize as the basis of this new period, the advent of massive platforms like Amazon, Facebook, and Ant in China. Just a quick tour.
And to take a very, very good tour. And related to that, if I understand it correctly, fintech is especially having an impact in Asia. Could you tell us more about the historical, current, and expected future impact of fintech there?
You know, I think when we talk about fintech, it's interesting because we think about over the past 10 years, lots of discussion about the possibility of disruption, of incumbents. And generally speaking, what we've seen in most financial systems has been less of a disruption by small new entrants, by fintechs. And probably where we're beginning to see the greater potential for disruption is really the emergence of large platforms. If we think about the platforms, we can think about Visa, we can think about MasterCard, we can think about PayPal, we can think about BlackRock, we can think about Ant. But where we've really seen the big transformations are in markets where financial systems 10 years ago weren't working very well. And that's often across Asia. And so where we've actually seen the biggest transformations, China, which has experienced the most rapid and complete digital financial transformation we've ever seen anywhere in history. A similar process taking place even more rapidly across India. And we're now seeing similar processes across Southeast Asia. Why? Because in each case, the existing financial system didn't work very well. And so we saw the use of technologies as a way to leapfrog problems in the existing system. So if we think about China, a long-term problem that the existing traditional commercial banking system, the entire financial system, was rather inefficient, and it was very poor at getting money to the private sector and small and medium-sized enterprises, which drive the economy. And so an experiment which allowed the application of new technologies by new entrants to try to solve this problem. And so we see the growth of players like Ant and Tencent initially providing electronic payments, then moving to a variety of asset management, lending, investment, insurance, and other programs, and effectively trying to provide a mechanism to address weaknesses in the existing system. A similar process in India, where we have seen the government putting in place a series of underlying infrastructures, digital ID, interoperable electronic payment systems, almost universal account access for individuals, from the objective of basically building rails to allow new entrants, new business models to try to jump in and leapfrog problems with the existing financial system. We're seeing similar things in Southeast Asia with Grab and others across ASEAN. And I think some of the most interesting is if we look at a place like Myanmar. Myanmar has a few thousand ATMs in a country of 70, 80 million. But they have, because they were a very late mover, over 85% smartphone penetration. Now, why would Myanmar bother with checks, with ATMs, with a traditional financial system, if it can skip immediately to a mobile smartphone-based system? And I think that's why we've seen, in the context of Asia, these moves. It's the combination of the ability to leapfrog with technology, and in particular, widespread availability of communications technologies, not just mobile phones, but smartphones and mobile internet.
Fascinating, thank you. Then on to Navroop. Could you tell us more about how this relates to blockchain, especially how this is transforming the world, especially in the context of finance, complex systems, and network theory?
Sure, Karan. Thank you for that question. It's interesting, and just Dan, you just talked about I think an excellent overview of the financial technology sector, I guess, but also embedded the general, I guess, human anthropological uh, evolution thus far. Kind of coming back to your question, Kuhn, here around, well, what is the intersectionality of fintech with complex systems and network science? I think we need to take a step back and say all socioeconomic systems are complex systems, just like biological systems, right? And they follow similar rules in terms of independent parts that interact with each other and lead to this emergent phenomena, as we call it, and I'll come back to it in a second, um, that cannot be observed at the micro level, or when you study the system at the level of the individual, whether this is humans or we're talking about perhaps in the economics scenario and an organization, right? So 2018, I gave my TEDx talk on this, and talked a little bit further about what that really means in terms of taking that learning from biological systems and really starting to look at the world as interconnected, overlapping networks, which is really the core, which is the structure of the system, right? When we call it something a complex system, we are essentially looking at a network structure underneath it. And one of the key things that I heard, as I guess as a feedback on that talk, was you start to go beyond thinking linearly about systems where 1 + 1 is 2, but then you start to look at systems as uncertain, as unpredictable, and exponential in nature, trying to learn the mathematics. And human brain is not transformed. And I think for this audience, it's particularly relevant. But human brain is not quite used to thinking in terms of the exponential. We think linearly. And to Dan's points earlier, he traced a whole lot of historic events that mark the evolution of financial technology, or what we call financial technology now. I think one of the key defining features is this path dependency that occurs, right? Where one event ends up defining the possible set of events that can occur later. So I think that's I guess a quick and dirty around looking at fintech and sort of exploring the intersectionality and starting to look at the world, and not in a linear way, but a series of, as I mentioned, dense overlapping networks. So I'll pause here for now.
And how does this relate to blockchain, considering your expertise in that?
Great question. So for the past 5 years, I've looked at this, and very relevant, because here's the thing: 200 years of economic literature is looking at systems in a linear way, with just recent exceptions to that, right? Where essentially you're looking at a model individual, and you just multiply that by whatever number, and that is the macroeconomy. But that's not how it works, right? The intersectionality and the interactions between various individuals also have value, and that is not captured by traditional economics. So I'll give you a quick example here. So say you drink 1 cup of coffee a day, right? But say you have a study group where you meet other economists, and every time that happens, you go to a coffee shop and you buy another coffee, right? So if I were to just look at an individual, I would just say, okay, this person drinks 1 cup of coffee. There are 1,000 individuals in the system. The demand for coffee, the aggregate demand for coffee is 1,000 coffees. But what it fails to account for is what happens when two individuals are meeting up, right? Um, so you're losing a lot of information in the system, and what's happening as a result of that is that your predictions and the reliability of whatever you're pursuing is quite shaky, actually. And so, what blockchain over the past few years has offered to the space is really to look at the infrastructure, the system, as that network, as I mentioned before. And rather than a centralized structure where value is captured by a single entity, right? A bank is a great example. Um, we are talking about value that is created by a lot of different entities or nodes in that system, a more scientific way to look at it, as is the case with all platforms, right? But then being able to distribute and appropriate that value in a decentralized manner. And that's really where things get really exciting when it comes to blockchain. And I'm happy to go deeper into it, but again, I'll stop here for now.
And let's move on towards Daniel Azzi. So could you give us a real-life example of finance in the 21st century? For instance, your work on the Lebanese dollar, for which you have coined the term LOLAR, ticker symbol LOL. Could you tell us more what happened in Lebanon that led to the rise of this LOLAR, especially for students unfamiliar with Lebanon's political economic history?
Hi, good morning, everyone. So the LOLAR, I mean, in all banking systems in the world, in all monetary systems in the world, there is a chunk of money that's digital, that doesn't correspond to, I guess, physical currency. And the multiplier effect also in banking or fractional banking even increases the currency supply much more than quote unquote what is real. So in Lebanon, we took that to an extreme because we are using the US dollar as a currency in the banks. In fact, over 75% of our deposits are in dollars and it's multiples of GDP. What ended up happening is that we created a monetary system in dollars, which is much, much larger than what's available in real dollars. And this was used to finance the peg of the lira, the local currency, at 1,500. So what ended up happening is that there was the dollar claims against existing real dollars became multiples, huge amounts. So today, for example, there's $115 billion in bank deposits that have a claim against the existing real dollars, and the existing real dollars are at this point less than $18 billion. So in other words, there's less than 1 out of 9 or 1 out of $10 left in the system. As a result, I started using the term LOLAR to describe the fake Lebanese dollar. So this fake Lebanese dollar, you could use it to the LOLAR, you could use it to buy stuff in Lebanon, like you could buy, an apartment with it. You can even pay salaries with it. However, it's not good to be transferred overseas. So today, nobody will sell you a brand new car for this LOLAR. Nobody will sell you a Gucci bag for this LOLAR. Nobody will sell you an iPhone. I mean, they'll price it accordingly anyway. So the only thing you can buy is real estate, and that's because you can't just ship your apartment and sell it in Dubai. So effectively, we've just created a parallel currency, even though officially they're calling it the local dollar, but that's basically how the system has evolved. And the LOLAR today, the value of the LOLAR, it takes 3 or 4 LOLARs to buy 1 real US dollar.
It's very, very interesting and concerning. Considering that economics graduates get especially more theory on this, how should we prepare our graduates to deal with such situations? Should we include more real-world examples such as the LOLAR into their economics education or finance education, or something else? How do you see this?
So I can take up that question. Actually have an interesting story there. So I am born and raised in India, and before I moved to Europe to pursue my second and third masters, I actually already graduated from a master's program, which was focused on mathematical economics and development economics and such. And one of the things that I learned when I came to Europe, in Italy in particular, my colleagues were actually campaigning for more heterodox views in economic departments, and it was economics departments, and it was quite surprising to me. What I learned at the time was that there's literally just one school of thought that is taught in economics departments. Or at least most of the economics departments, at least in the West, particularly looking at US and UK in this case. And we, on the other hand, we studied everything from ancient economic thought to Keynes and post-Keynesian, and classical and neoclassical and everything in between. So I think what's happening is just the standardization and almost like creating a cult where econ students are told to just think in a certain way. And I think what they're lacking is the depth and the philosophy and the history side of economics, because this is a human invention, right? And so money is a human invention. And I think what ends up happening is that the new graduates, and I'm using this term quite generally here, we end up perpetuating the same system that is perhaps broken or fragmented, right? And I think the Lebanese dollar is a good case in point on, of course, money creation and creating leverage, which is very well understood in the West. The only problem is the Lebanese government may not enjoy that kind of credibility that governments here do, right? All fiat currency is just a promise saying we'll pay goods and services worth this much face value, right? And so I think what needs to happen when it comes to reforms in economic departments is to bring that depth and the sheer multiplicity in perspectives in history of economic thought, in thinking about systems outside the box. And I would definitely say complex systems for myself, I know it changed my life, and you start to look at the world in a non-linear way, which I think would ensure that the next generation of young economists are not just simply perpetuating an overstretched system. So I'll pause at that.
It's very fascinating. I personally also am quite interested in complex systems and quite agree with you on quite some of those topics. Douglas, how do you see this?
I very much agree with Navip's analysis. And I think it's something that if we look at economics and finance, certainly actually by the beginning of this century, prior to the 2008 crisis, very much we had seen, particularly in academic economics and finance, almost a complete dominance of applied mathematics, of quantitative approaches, which I think were a lot of consensus didn't work very well in the context of the 2008 crisis. And I think it's something that 2008 did cause a fair amount of rethinking, but it's not being seen sufficiently widely in many curricula. I would highlight some of the work of the Institute of New Economic Thinking as going in the right direction. But I think very much that when we're thinking about economics and finance, particularly at the master's degree level, it has become very narrowly focused. And I think that makes it difficult from the standpoint of addressing new developments, particularly things like technologies that don't necessarily easily fit in those frameworks.
Yes, I agree on that. I think that is also something we're really focused on, rethinking economics now, that we really need to see this differently. Daniel, how do you see this?
I think, yeah, I mean, I think it was covered by the panelists in terms of the money creation and the credibility of the Lebanese government versus other governments that issue currencies. In the end, all currency is fake or virtual, but some currency is just simply more virtual and fake than others. It's kind of as simple as that. To give you you know to give you an example of the Lolar phenomenon, how it evolved. I want to just can I share a graph here? I just don't have the oh, here we go. Share. I got it. I just want to share this graph, which is my
I don't think we can
favorite.
see it yet. Let me.
Yeah, I'll give it to you. 1 second. I'm just going to give it to you right now. I think I can do it. So this is a graph. Can you see it?
Yes, I can, but I'm not sure it's in the recording. But I do think that it should be. And for
It should
those
be, yeah.
who are seeing, could you that are not seeing it? Could you shortly describe it as well?
Okay, so the graph that I just showed you, this is the evolution of deposits. This graph, by the way, was made by a Dr. Nafiz Zou. He was at Oxford Economics and he moved somewhere else. And it's my favorite graph. Like, if you don't want to hear me talking for an hour, like just looking at that graph for a minute tells you what happened. This is from 2009 to 2019, the evolution of deposits in the banking sector. And the blue line is what I call the real dollar. The gray line is the principal. Okay, so if you put $100 in the bank cash, the gray and the blue would be equal. If I pay you 10% interest on that in a year, the red, that shows the red. The red is the 10%. So you could see that we had a fractional banking problem the whole time for quite a while, since 2009. But starting 2017, that's when we had the exponential collapse of the system, where there was a divergence between the real dollars and the Lolars. So in 2016, the central bank started a series of financial engineering, which is really just after you take out all the bells and whistles, he basically paid a lot of interest to seduce money from expat Lebanese and others outside Lebanon, and basically printed lira in return. And so there's a blip up in 2016 where the blue line increases a little bit, real dollars, which is the money coming in. And then from 2017 to 2019, there's a massive divergence between available real dollars upon demand of depositors, and the whole party was over in 2019 in October or November. So effectively, that's basically a fiat currency system on steroids, I guess.
Yeah, I fully agree, and it really shows indeed how different sometimes the real world is from the theory. And considering that, and also what Douglas and Arup said about that the masters and such in finance are quite narrowly focused on some of the more neoclassical models, how do you think that we should include such real world perspectives, especially for Dan?
I mean, I would just say, I think there's a lot of attachment to, I mean, the nature of scientific research is that you build upon what was previously done, right? But what we're seeing, and I think, Doug mentioned that when it comes to technology, we're essentially looking at an unknown into the future, right? Referring to this quadrant of risks here, and what we necessarily need to think about is there would be things that don't have a precedent, and we are looking at phenomena, and this kind of applies to biological systems as well. I mean, climate change, another case in point, where we are going into kind of an unknown domain. So just what has happened in the past is no longer a reliable framework for what might come into the future. And I think that perspective is completely missing. So I guess the attachment of academic economists to what they've done in the past, the papers they've written, the models they've built, their PhD thesis, which they keep building on for the next 30 years, I think it's just hurting all of us. There is need for more entrepreneurial economics, at least that is my path, and it was because of this learning that I think I went down that path, where we need a lot more courage and bravery, both in pursuing the work that we do, but also in terms of imagination, looking at the future, and rather than just sort of being attached to um, titles or funding, or just what has been done in the past, knowing full well that this is just something that's theoretically elegant, but absolutely doesn't serve anyone in the real world. And I think what has happened as a result of that is that over the past 20 years, the profession has lost a lot of credibility, right? And you look at one crisis after the other, and of course, they don't listen to the economists. A lot of decisions are political. But also at the same time, they do turn to economists when the crisis strike, and what's happening is our models are not predicting anything any longer. I mean, just the whole exercise of predicting a highly complex world is kind of futile. I think the focus should be on building resilience, and perhaps more than that, anti-fragility. And I'm sure Doug and Dan have a lot more to say on that. But I think that shift has to happen, and whether this is by tweaking incentives or this is from, I guess, our own kind of reckoning around the fact that the econ departments are just producing copies of the same way of thinking, which is just serving no purpose in the world, has to happen pretty quickly.
I would just say that I definitely very much agree with that. I think if we're looking at looking forward, I think this focus on complexity, on resilience is really central. And I think, if we're looking at the possible impact of 2020, I mentioned this idea of increases in digitization, but in some ways we're seeing it reinforcing trends that are already there, but with a bit of luck accelerating that. So one, I think we can see it on the technological side, where many of the technological developments we've seen across 2020 as a result of COVID were trends that were happening before, but COVID has pushed them in an entirely new direction and speeds. That's one on the technology side. The second is really around, I think, sustainability. If we look at COVID, it's an existential sustainability crisis. And what we're seeing is, trying to figure out how to address it, but also the need to think forward, particularly as we think about dealing with other existential sustainability challenges, of which we're likely to see an increasing number over the coming decades, and building more robust systems, particularly on the financial side, on the basis of technology to deal with those. And of course, one of the big challenges is that if I'm thinking about my sort of third big trend coming out of 2020, it's accelerating attention between globalization and fragmentation, particularly among major powers, which I think is going to pose a real challenge, both from the standpoint of sustainability as well as from the standpoint of technology. But with all of that said, and knowing that Dan has to go in a minute, I just wanted to highlight one area of economics where I think there is some really interesting work being done, and that's particularly on the behavioral and neurological side. It's something that we didn't see a lot of interest in before 2008, but post 2008, I think a real questioning of some of the neoclassical assumptions around rationality. But in particular, we've seen a lot of both experimental research as well as genetic research looking at human behavior, which fundamentally impacts on the way that we think about designing economic systems and models. And for me, I think this is some of the most interesting work being done.
Yes, I agree with you that this is indeed very, very important topics. Afterwards, I would like to also come back on how we can actually change this into economics education, why it is so difficult and resilient, but considering that Dan has to go soon, I was wondering, how do you see this, and how do you think that we can implement this in the real world economics education?
I think it's sort of a different thing for as was mentioned earlier, for developed countries versus developing countries or third world countries. In third world countries, and this is time and time again, it's always about we always run into a problem which is related to a dollar crisis, or related to borrowing in currencies that are above our pay grade. And this happens in developing countries, or even it happened in East European countries that are part of the EU, when they were borrowing against the franc to try to save on their on the interest rates in their own currency, the zloty, if you remember, in the 2008 crisis, or even Iceland. So time and time again, the problem is always about borrowing in someone else's currency, a currency that you don't control. So and I'm gonna just address this for the developing world of you have to avoid debt in a currency that you don't control. Don't be enticed by the low interest rates that are offered, and there's a reason for those low interest rates. It's always about risk and return.
And considering you also held various executive positions at investment banks and were the chairman and CEO of Standard Chartered Bank in Lebanon, do you have any advice for students that wish to enter this field of investment banking and related?
I think that this is a tough question. I enjoyed my career in banking. I think it was very, very lucrative. You just have to be careful about the moral hazard. I think that one of the reasons for the 2008 crisis was the fact that we had to we were being paid in a way that incentivized us to take excessive risk with other people's money. Now, the West has dealt with this problem to a large extent by using clawbacks. The regulators in Britain now can claw back the bonuses of executives many years after they leave. If something blows up, the executives get paid in stock that vests over 3, 4, 5 years. One of the reasons I think we got to where we got to in Lebanon was because people were being paid large bonuses in cash, so that if something blew up, it doesn't matter. They don't lose anything, so they're incentivized to take too much risk. So I would just advise students to be careful about, even if the incentive structure is made in a way that incentivizes them to lose money, or because they can to lose other people's money and maximize their own compensation. They need to be very, very careful, because there's also a reputational risk. They don't want to make a lot of money and then damage their own future.
Yes, I agree. Considering you have to go soon, if there's one thing you could say to students in economics watching this related to the topics we've discussed, what would it be? If still possible for you, then.
I'm sorry. Can you repeat the question? I was broken up.
Of course. So, if there's one thing you could say to students in economics related to the topics we discussed today, what would it be?
I think that I'm a big fan of the common sense approach. Sometimes there's a lot of analysts that looked at Lebanon and missed the danger signs in the country, because we all read the same books. It's the same macroeconomics book. It's the same ratios. We look at debt to GDP ratio, stuff like that. So a lot of people were looking at the Lebanese debt to GDP ratio. If you do a search in the literature today for the last 3 years, people are always talking about the fact that we had one of the top 2 or 3 debt to GDP ratios, the $90 billion in debt. And as a result, people missed the $110 billion in balance of payment deficit, or debt with the central bank, which totally eclipsed the debt of the government. And in fact, the government debt that Lebanon had wasn't that significant, because less than 5% of it was foreign debt. The rest of it was all internal debt. It was all central bank debt. And remember, the literature teaches us that internal debt is not a big problem. Debt in local currency is not a big problem. And I think the Lebanese case is going to be studied in the future to show you that the traditional metrics that people look at sometimes don't really capture the real danger.
Thank you, thank you. I think that is indeed an issue, and hope something which we will study. Thank you for your time. In case you need to, I think you have to leave soon. Then I would like to go.
All right, I gotta go.
Thank you
Thank you
very
very
much for your
much,
time.
guys.
Thanks,
Ciao.
Dan.
Then back to Douglas and Vroop. What I was very curious about is, well, this I think shows indeed that there is a very systematic issue in economics education. For instance, that it's almost like we're all studying the same literature and studying the same models. Then you get these, perhaps partly these type of issues. So how do you think that we could then change these models that we study? Because I think that many agree we need to change something, but I think we've been saying this since the crisis and very little has changed.
I think there is some progress, but probably what is going to be necessary is kind of relating to what Dan was talking about, a change in incentives. In other words, to the extent that finance academics continue to be rewarded for the same performance indicators, which is a certain type of publication and a certain type of venue, there's limited incentive to change, really. And likewise, from the standpoint of universities, to the extent that employers are happy with hiring the product, then there's little incentive to change. I think, though, that what we are seeing, certainly in the financial sector, has been a real drive towards hiring an increasing number, an increasing percentage, and in some cases, an absolute majority of people who are outside of economics and finance, in particular in recent years from STEM subjects, as I think the difference between finance and data, or finance and technology, as any distinction has ceased. The reality that those from STEM backgrounds bring with them very important skills that may not necessarily come with those from economics and finance backgrounds. I think that is probably the key direction, is from the incentives of the hiring, which are probably much less sticky than the existing directions of the academic profession.
Vroop, how do you see this?
Yeah, so I think I kind of already responded to that, and Doug just built upon that around the incentives of academic, economists, and I really like that he talked about the other side, which is the demand of economists in the labor markets, and the fact that that's sort of shifting away, and the profession is sort of shrinking. Traditionally, econ has been basically a very influential profession, right? And but that has ceased to be the case over the past 20 years or so, and so, moving forward, if the profession has to stay relevant, it has to change. That's a given, and that's happening already. And I personally think, like I mentioned before, that entrepreneurialism is needed to change, economics curricula, and I think that's sort of what you're also doing at Rethinking Economics, and at the institute, and also is the mission of the entity that I'm building, which is an impact ecosystem working at the intersection of economic science, business, and technology, right? And so combining these dots, and again, you have to look at systems in an integrated manner. You cannot study a certain subject in a silo and hope that would bring anything fruitful, right? Also with innovation, and also with the fact that a lot of knowledge has already been built. You see that incremental knowledge is what we get when it comes to core sciences, right? So the innovation is really happening at the intersectionality, right? And so it's harder and harder to innovate at the core, right? As I say. So I think what I would really encourage economic students is to think in an integrated way, and obviously econ departments need to change as well, but it's not all hopeless, right? I learned a lot in econ departments, and including complexity science and network science. So there's definitely economists who are looking at things from a more computational perspective, which is another something I think we haven't quite covered during this conversation, but is very important, where models are all computational, or where we're looking at data sets that didn't exist 5 years ago, and that has completely transformed the profession, right? And what that is doing is that I think the boundaries are blurring already, where physicists are or coming into economics and are the ones building the models, or economists are sort of going and to different fields and doing other things, and that is a trend that will continue to happen, and it's a good thing.
So then, perhaps back to Douglas. So if I'm hearing this, I hear, I think, especially the real-world economic examples. I hear heterodox economics. I hear interdisciplinary economics. Could you give what do you think should be especially included in economics education, and what do you think we should change to include such things?
I think the foundation is really actually going back to one of Nafroop's initial comments about the foundational history and evolution of the discipline. So often it goes straight into mathematical models and actually misses the historical evolution. I think that's something that is really important. On one area where I'm optimistic, where we are beginning to see some changes, another area that Navroop mentioned, and that is the interdisciplinarity. It's something that in universities you hear a lot, interdisciplinarity, but the reality is that individual academic disciplines do not value interdisciplinarity. They value their own disciplinary approaches, and that's what gets gains. But where we are seeing from the demand side some changes is that increasingly employers do want employees that are coming with, for instance, if we're thinking about financial technology, an understanding not just of finance, not just of technology, not just of regulation, but all of the various pieces. And what that is forcing is universities increasingly to at least allow students themselves to build interdisciplinary approaches. And I think as we begin focusing, and this is something that we are seeing initially, of course, in the US, but now it's starting to take root in academic systems around the world, systems where they focus on impact as opposed to just academic publications and research grants. And to the extent that you're looking at impact, then by necessity, you are having to apply interdisciplinary approaches. In other words, to understand a challenge requires people working at it from different directions. And I think from the incentive standpoint, that's something that from the standpoint of societies, governments, education, funding, we should continue to encourage is, value blue sky research, but also reinforce the value of real world impact.
Yeah, I fully agree with you. I really, especially in your introduction to fintech calls, I really appreciate your historical emphasis there. I found it incredibly fascinating and learned a lot through that. And at Rethink Economics, we actually did, I think our UK branch actually did a study related to the demands from employers. And we found here as well that they highly, highly want this interdisciplinary candidates, not just very good mathematicians. So yeah, I fully agree with you there. And I think indeed interdisciplinarity is very important. And Navroop, how do you see this?
Yeah, I think very well said. What Doug just mentioned is perfectly captures what we're looking at and what we should be looking forward to. I think just kind of, I guess, winding up, I would say, once again, there is need for products, productization, humanization of economics, right? And that's a lot of what we do. Like, how do you combine keeping human at the center, human outcomes at the core when you're building, for example, designing markets, right? Which barely few people know about, that economists design markets from scratch when it comes to new innovative products for which markets don't exist yet. And, that raises eyebrows. It's like, oh, that's interesting. I've never heard of that, right? And so, and what that future looks like, right? Where humans, rather than being a factor of production, human outcomes being the actual, end goal that we are pursuing, and production being a path towards that, a path of prosperity towards that. So a lot of what we're doing, and if that's of interest, I guess, to the audience here, is kind of turning that upside down and saying, well, we got it wrong. And so looking into the future, what we want to build is that human-centered, digital-enabled, digital facilitated, but because what digital technologies provide us is a way to augment our capabilities as humans, and go beyond with the physical world and kind of in the realm of imagination, and capture and crystallize some of that, right, and build that in the real world. So so it's super exciting, actually, and I think, for me personally, I don't imagine going back to, in any shape or form, to a traditional economics department. It's like I probably can't be there for a single day, quite honestly, because I think there's so much exciting work to do from an impact perspective, from rethinking, rebuilding, combining these dots, like working with designers was kind of life-changing for me, because design is all about being succinct, working backwards from the consumer experience, which economists have almost zero experience unless you have done something along those lines. And so you start to think about things in a different way. You start to think about economics, which is essentially looking at the system, but then what does that come down to, or boil down to, when we are interacting with individuals. So I think from my side, from the ecosystem that we've built and are building, we are looking at humanizing economics. We are looking at combining the power of design thinking, behavioral economics. Of course, the key precedent for that. I actually wrote the first paper on behavioral economics applied to token valuation, and what value means, and where value comes from. And it's been quite remarkable sort of seeing the industry sort of pick up work like that and apply that, and sort of on a nascent industry like blockchain, like digital assets, and run with it and what that means. So I think it's good time, it's exciting times. COVID is also sort of bringing, forcing, I should say, that innovation that's long overdue, and Doug has traced a whole bunch of that during this conversation. And so moving forward, that's what I would encourage, economists, young and old, and encourage particularly female economists to have a greater say. That's my goal, to inspire and encourage and facilitate diversity in economics, because that's part of the big problem, where it's same kind of people are building same sort of stuff. Think of an economist, sorry to say that, but you think of a 50-year-old white dude on the East Coast in the US, and so that diversity is lacking, and that's hurting us massively. And the systemic failures are a great case in point. So my hope is that with the COVID crisis, we can no longer kind of live in a, in a cave and deny the essential interdependencies of our planet and everything in it. But we work with that.
Yes, yes, I fully agree with you on the importance of these topics. Actually, we will also be having an interview which on mechanism design itself, on how do you actually build a market from an interdisciplinary, a mathematical, computational science, economics perspective. So that's fascinating. So, Douglas, I saw that you had some enthusiasm, that you said something enthusiastic related to this in the chat. Do you have any last comments on this before we move to the final questions?
No, I would actually say that comment from Navroop is probably a perfect way to wrap up today's session. Really good.
Fully agree. Then I have one last closing question. If there's one thing you could say to students in economics watching related to the topics we discussed today, what will that be?
I would just say 2 words, and those are be brave and imagine. I'll add that.
Douglas?
I think the key one that I would say is read widely. Don't get stuck in thinking that things will necessarily continue as they've done before. The exciting possibilities are when you see things going in completely different directions. And I think 2020 has shown it happens.
I think that are 2 beautiful statements to end today with. Thank you for your time. Thank you for listening, and we'll see you for the next interview.